what I want to do is to describe the mechanics of the actual investment in the futures market. We've gone through some examples as to how to make an investment in the futures market. And now what I want to do is to go through and describe the details of an actual futures transaction. The perspective that I will take is the perspective of just an ordinary investor. So this is an investor that's not necessarily using the futures market for hedging, but more likely for speculation. Now remember, if we believe that the price will increase, then we'll take a long position in the futures market. If we believe the price will decrease, we take a short position in the futures market. Now let's go back to our example of corn, and the futures price is $4 per bushel. And I'm a speculator, and I believe the price of corn should go up in the market. So I'm going to take a position, an aggressive position in the market, where I'm going to agree to purchase 1 million bushels of corn at the end of September, and the price in the futures market today is $4. Now, in order to do this actual trade, I need to make a deposit with my broker. And this deposit is called the margin. And if I'm a good client, this margin can go into a money market account and I can earn interest on this. And each futures exchange has a specific set of margins for the commodities that are traded there. And the margin is structured into two parts. First is called the initial margin, and the second is called the maintenance margin. And let me describe how this would work. Suppose that I do this transaction and I agree to purchase 1 million bushels of corn the third week of September for $4 a bushel. Now, I have to deposit some good faith money because the price of corn could actually go down. So what I do is I put a margin deposit down that might be specified by the exchange, the exact amount. And suppose the amount of money that I put down is $100,000. Okay. Now, suppose that the price of corn goes up the first day, and it goes up from $4 to $4.10. This is good news to me. Money is transferred into my account, and now my account has $200,000 in it. I've got the $100,000 in margin, and I've got another $100,000 in money that was transferred in when the contract was rewritten to $4.10. Suppose the next day the price of corn drops from $4.10 to $3.90. This means that I have to transfer out of my account $200,000, which wipes out my profit and my margin deposit. I will get a call from my broker. This is called a margin call. And what it means is that I need to post another $100,000 in order to fulfill the margin requirement. Okay, so if I do not fulfill this margin call, then I'll be taken out of the market automatically. And I'll be taken out by doing a so-called reverse trade. So what happens is that I've agreed to purchase 1 million bushels of corn in September. And a reversing trade will be to sell 1 million bushels of corn at the end of September. So it cancels me out of the market. So suppose I make the deposit of $100,000. Now, let me distinguish between initial margin and maintenance margin. The maintenance margin is the margin that needs to be maintained in the account. There's an initial margin, and if you go below the maintenance margin, then you need to repost the full amount of the initial margin. So suppose the maintenance margin is $50,000 and the initial margin is $100,000. In the example where the corn went from $4.10, suppose it dropped to $3.95. If that's the case, then the the amount of loss that I'll have is $1.50, and this means that the transfer out in terms of funds will be exactly equal to $150,000. What I'm left with in the account is $50,000. This is my margin for maintenance. I will get a call and I need to increase the margin up to $100,000. So the maintenance margin is set below the initial margin, and these are some of the things that we have to worry about in the mechanics of the futures market.